Have you ever stared at a chart, waited hours for the perfect setup, the one all the textbooks and gurus told you was a guaranteed winner? You clicked buy with total confidence and then, almost instantly, watched the price tank. It feels personal, doesn't it? It feels like the moment you entered the market, someone in a glass office somewhere got a notification, laughed, and pushed a button to take your money. And look, here's the thing. You're not entirely wrong. You aren't being watched by a person, but you are being hunted by a mechanic. You are trying to swim in an ocean where you are a guppy, and you're trying to eat the same food as a whale that weighs 50 tons. Most people think the market moves because of magic lines or RSI indicators. It doesn't. It moves because of one thing: aggression. And until you learn how to spot where the whales are swimming, you're just going to keep getting eaten. My name is Dalkin, and I spend way too much time thinking about institutional order flow. If you're someone who is tired of your stop loss being used as liquidity for the big banks, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Today, we aren't talking about patterns, we are talking about the physics of money. I'm going to show you how to stop trading against the current and start riding the wake of the biggest movers in the world. Let's get something straight right off the bat. The way you were taught to trade is probably wrong. Most retail traders, that's you and me, are taught to look for support and resistance. We're taught that if price hits a floor 3 times, that floor is strong. But think about this logically for a second. If you keep hitting a wall with a sledgehammer, does the wall get stronger? No, it gets weaker. Here's what most people don't realize. The charts you see are just a visual representation of human psychology and order flow. When millions of retail traders put their stop losses below a double bottom, they aren't creating a safety net, they're creating a pool of gasoline. And the institutions? They are the match. There's a statistic often thrown around in this industry called the 90-90-90 rule. It states that 90% of retail traders lose 90% of their money in their first 90 days. Why? Is it because they're stupid? No, it's because they are predictable. They are providing the liquidity that the big players need to enter their positions. So, if you want to be in the 10% that actually builds wealth, you have to stop thinking like a retailer and start thinking like a market maker. Now, you might be thinking, okay, Dalkin, but how do the banks actually trade? To understand this, we have to do a little math. Let's say you want to buy one lot of Euro/USD. You press buy, you get filled instantly. Why? Because there's almost always someone willing to sell you one lot. The market is liquid enough for you. You are like a pebble thrown into a lake. You make a tiny ripple, but the water level doesn't change. Now imagine you are an institution, a hedge fund, or a central bank. You need to buy 10,000 lots. You cannot just click buy. If you click buy on 10,000 lots at the current market price of 1.0500, you will consume every single sell order at 1.0500. Then you'll eat the orders at 1.0501, 1.0502, all the way up to 1.0550. This is called slippage. By the time your order is filled, your average entry price is terrible. You've moved the market against yourself. So, here's the problem the whales face. They have too much money. They need to find a place where there are enough sell orders to match their massive buy orders without ruining their entry price. And where do they find those sell orders? They find them at your stop loss. When you are in a long position, your stop loss is a sell order. So, the institution pushes the price down, triggering all the retail stop losses. This creates a flood of sell orders. And who's there to catch all those sell orders? The institution. They are buying while you are panic selling. This is why the market always seems to turn around exactly where you got stopped out. It's not bad luck, it's a liquidity transfer. So, we know why they do it. Now, how do we spot it? Institutions cannot hide. They are too big. When they finally enter the market and push price in their desired direction, they leave a massive footprint. We call this displacement or imbalance. Look at your chart. Stop looking for cute little doji candles. Look for the massive, energetic candles that break structure. Look for the move that clearly says we are leaving this price level and we are not coming back. Where that move started,
That is your demand zone if buying or supply zone if selling. Here's the thing. This is where the psychology gets interesting. When price explodes upward, leaving that zone, it creates an inefficiency. There were zero sellers able to participate in that move up. The order book is thin. The market hates inefficiency. It's like a vacuum. Nature abhors a vacuum, and so does the market. Eventually, price must come back to that zone. Why? Two reasons. Number one, to fill the fair value gap or imbalance left behind. And number two, to fill the remaining orders the institution couldn't get filled on the first push. This is the only setup you need. You wait for the explosion, the wake, and then you wait for the return, the mitigation. Now, I know what you're going to say. Dalkin, I see big candles all the time, but the zones fail. Yeah, because not all zones are created equal. You can't just trade every gray box you see. That's how you lose money. To filter out the noise and find the high probability setups, we need a checklist. I use 3 specific criteria. If a setup doesn't have these, I don't touch it. Criterion number 1, the break of structure, BOS. Did the move actually achieve anything? If a green candle shoots up but fails to break the previous swing high, it's weak. It means the buyers didn't have enough conviction to conquer the previous sellers. We only want zones that shattered the enemy's defense. Criterion number 2, the sweep, inducement. This is the most important one. Remember how we said banks need liquidity? We want to see a fake low formed just above our zone. We want to see retail traders getting induced into buying early. Why? Because when price finally drops, it will sweep their stop losses, generating the fuel we need to launch off our zone. If there is no liquidity built up before the zone, you become the liquidity. Don't be the liquidity. Criterion number 3, discount pricing. This is simple economics. Visual, Fibonacci tool measuring the range. Bottom 50% is green. If you are buying a house, do you want to pay premium market value? No, you want a deal. Institutions are the same. They do not buy at the top of the range. They buy in the discount, the bottom 50%. If your zone is in the top half of the range, the premium, ignore it. The risk to reward isn't there. This brings us to the final piece of the puzzle, execution. This is where most people fail, not because they can't read a chart, but because they can't manage their emotions. When price comes back to our zone, it's going to look scary. It's going to be a red candle moving fast. Your brain, evolved to run from tigers, is going to scream, sell, danger. But you are going to do the opposite. You are going to place a limit order at the zone. You place your stop loss strictly below the zone, not just roughly below it, strictly below. If price breaks the zone, the thesis is wrong. We accept the loss. And this is where it gets really interesting. Let's talk about the math of wealth. If you trade like this, waiting for the right zone, in the discount, after a sweep, you can achieve a risk-to-reward ratio of 1 to 3, 1 to 5, or even 1 to 10. Let's say you aim for 1 to 3. That means you risk $100 to make $300. Do you know what your win rate needs to be to break even? 25%. You can lose 75% of the time and not lose money. If you win just 50% of the time, which is a coin flip, you will become exponentially wealthy. Most retail traders are trying to win 90% of the time with a 1-to-1 risk ratio. It's stressful and it's mathematically inferior. We play the long game. We take the losses small and we let the winners run massive. Look, trading isn't about being smarter than everyone else. It's about being more disciplined than everyone else. The institutions have the money, they have the algorithms, and they have the data. You cannot beat them in a fist fight, but you don't have to. You just have to spot their footprints. Wait for them to splash into the water, wait for the waves to settle, and then ride the momentum they created. Stop trying to predict the future. Start reacting to the truth of the chart. If you want to see me apply this strategy live in the markets, or you want a deeper breakdown of inducement traps, let me know in the comments below. Don't forget to subscribe if you want to stop gambling and start building infinite wealth. I'll see you in the next one.